Good morning, everybody. It's 10 a.m. Well, just about 10 a.m. It's 9:59 a.m. on Wednesday, March 22nd. I want to say hello to everybody. Happy spring to everyone. We have a busy week, as we always do at Attleboro Wealth Management. So we always, this kind of kicks off, it's Tuesday morning, but Monday is usually I typically don't have client appointments on Mondays, and that's kind of my preparation for the weekday. Also personal appointments, things like that. But so Tuesday morning really kicks off that very intense week trek for me, going all the way to, of course, Friday. But very excited. Good to see everybody. So today, for our financial planning topic, we're going to talk about non-qualified annuities. So I'm going to talk about what non-qualified means, what qualified means. You hear these terms at different times. So I'm going to talk about pros and cons of non-qualified versus qualified annuities. We, of course, are going to do our normal Slott Slott group updates, and we're going to do that for the first few minutes. And then we're going to talk about the markets and analyst reports, and then we're going to go into our financial planning topics. When you end the webinar today, you should open up into a survey. If you wouldn't mind, I think it's 5 questions. If you wouldn't mind answering those survey questions for me, I would really appreciate it. It's just, what you like about this webinar. I ask you to rate it on a scale of 1 to 10. I ask what topics you would want to cover in the future. And then I have an open box, what you think we could do better. If you wouldn't mind, that would help me, help also give you better material. So just raise your hand for me if you can see me and hear me. Okay. Okay. Thank you, everybody. It's good to know I'm not talking to no one. I've told you our office renovations are going really great. It's just a little bit of progress. Now 99% of the construction is done. It's just about getting everything together on the second floor. And what my wife and I do is we spend a day or two there, a weekend, just, doing a little bit more work. But one of the things that we're doing, I don't know if I shared this with you, is we're putting together a podcast/Zoom room on the first floor. So I have a back office. It's kind of tucked away from everybody. So one of my oldest son's friends, my oldest son is in the music business. One of his friends is a sound engineer. So he came out and looked at the space and gave me some ideas about what to do for sound, and gave me a list of equipment to order. And he's going to set it all up with an improved camera and lighting and sound. He got me a soundboard. So we do so many of these webinars now that, once a week, usually once a month, the classes, that it makes sense to make them the best quality we can for you. So that's exciting. That's going to be fun. It's going to be nice to have a dedicated area for that, for myself and really anybody else who wants to come in and use it in our company, not necessarily the public. So that's exciting. So we may see you from a different location at 1051 Lindenhurst Road. So the backdrop you may see is different. Okay, let's get rolling here. I'm just pulling up my notes. So just to remind you that you are recorded. I hope you're seeing the recordings on the website. There's a Q&A at the bottom of the screen. There are some new people. We just ended a class series. These classes are long. We started this series. We did it a little differently because we had to. We started at 6:30 and ended at 9:30 for 2 Tuesdays or 2 Thursday nights, and that's a slog for everybody. I mean, that's a long time, and boy, I love it though. It's just so much fun. And of course, I get to see a lot of folks after, and that's fun too. Do a lot of, talking about their situation and helping people figure this all out, right? How to set yourself up, not just so that you're not potentially running out of money, right? Or doing what you want to do and maybe leaving the amount that you want for your kids or your heirs, but doing it in a tax efficient manner. And many times, as you all know, and clients certainly know, is that, these small changes you make now are going to leave you with big results potentially in the future. So you are muted. There is a Q&A Please use the Q&A as we go, and then you, of course, are recorded. So last week, we also had Sarah Brenner join us. I hope you got to see Sarah either via video or, I'm sorry, either live or via the recording. And I think I already sent the recording out to everyone. I know I sent it out to the class, but I think I sent it to everyone. If I didn't, if you're not here from the class and you did not get the Sarah Brenner video, just raise your hand and I'll make sure to make a note to do that. Okay. Looks like I missed that step. All right. I'll have to send, I'm just writing myself a note to do that right now. Send. Well, I'll tell you, you're not lost though. Video, because you can access it on our website. So let me just share that with you. John, I'm going to refer to you because I saw you raise your hand. Hi, John. So if you go to our website here, so I had this teed up because I was planning on talking about trust tax rates, which are right here in our discussion. But if we go back to the home screen at attleborowealth.com, you should see events and webinars right here. So you want to go weekly webinars is, of course, our Tuesday webinar. Special webinars is where you'll find the latest Sarah Brenner video, and that is right here. Should you name a trust as your IRA beneficiary? So John, if you can't wait for the email to come out, or anybody else, you can just click in here. All you got to do is, if I click on this, it's going to play automatically, but you may have to put in your user email address, and that's it. And then you have access. But this is where all the special webinars are. So these are the ones we've done with David McKnight, Andy Ives. I did this one about the 4% rule, investment fundamentals. Brian Adler's in here. So Ed Slott. So this is a great one here with Steve Bobbert about Medicare planning. This is one that you should review if you're heading into Medicare. But all this is here for you. And it'll be there for a while. Some people, I've been talking about making this, and I talked to a couple of people that said you should make these only for clients or for some kind of subscription or membership, and we'll be doing that hopefully by the end of the year. But these are our weekly webinars, so we're all caught up. This was March 15th, so if you missed our discussion last week, you can do that. Neither my son nor I choose these thumbnails. YouTube does. Nothing worse than seeing your picture and video. Watching yourself in video is one of the worst things, isn't it? But let's move on. So I'm going to stop my share here. So John or anybody else, that's where you can find our weekly videos and special webinars, weekly webinars and special webinars. Stopping share. I'm sorry, I got to get that out of my screen there so I can reference it in a moment. Okay. So we had Sarah Brenner. We talked about, that was last Wednesday. We talked about naming a trust as an IRA beneficiary and a few other things. We talked about the Secure Act. We talked a bit about RMDs. We had a lot of great questions, as we always do. We've got very in tune and intelligent people who sign on to these webinars. I'm always impressed at the complex nature of some of the questions. And then our next thing that we have coming up is April 27th. We have David McKnight joining us live in Newtown at the Newtown Theater. And for you folks on this webinar, people that are often on the webinar, or and I do see who's on here, or clients, you're going to have an opportunity to have a VIP event with David an hour before the regular event. So that'll be fun. And the theater is a great venue. If you haven't ever been there, you're going to love it. And you haven't been there recently, you're going to love it still, because there are a lot of new renovations that I haven't actually seen yet. But they renovated the entire theater. So it's going to be fun. So join us April 27th. That is a Wednesday. The VIP event should start at 5 and the regular event should start at 6:30. Okay. We still, I'm looking at the headlines I've been tracking. Inflation, 7.9% year over year. We talked about that when it was last released a week or two ago. A lot of uncertainty still in Russia and Ukraine, and the Federal Reserve raised interest rates 1/4 of a point, as we know. but this still seems to be the discussion, right, that's going on in and driving things right now. And I'm going to talk about that a little bit later on. But let's jump into the Ed Slott, the mailbag, and the articles that are written. So Sarah, who we had on last week, and you all met last week, she wrote a good piece on just yesterday on IRA contributions. So there's always a lot of confusion about 401k contributions and IRA contributions and timelines and differences. So 401k plans, retirement plans, company retirement plans are different, and they have different rules than IRAs, individual retirement accounts. So always just try to remember that, because people will say, well, they mix up these, the IRS rules are complex. They have crazy dates and, crazy ages, 59 and a half, 70 and a half. It's the only area of our lives, I think, where you have these half birthdays. Now, when my kids were young, we used to celebrate half birthdays. So we'd go out, the kids would have an opportunity to choose where they wanted to go to dinner if it was their half birthday, and we'd all go out to dinner. And I like that, because my feeling always was we don't get enough of these, right? These birthdays then celebrations when they're young. So I just very selfishly doubled them up. But that's the only other experience in my life where you're dealing with these halves. Crazy required beginning dates for RMDs, and that moves. It's all confusing and crazy. But if you just break it down and you remember simply that retirement plans and IRAs, individual retirement accounts, are different, and they have to be individual retirement accounts. I often get questions, well, can my spouse be a joint owner on my IRA? Can't be, right? It's an individual retirement account. Of course, your spouse could be your beneficiary, but it can't be an individual or a joint owner. So then we get to the contributions, and this article is about the contributions. So again, 401ks and retirement plans, other retirement plans like 401ks, they have different rules than IRAs. You have to make your contributions in your retirement plans, your company retirement plans, by the end of the year, just like your Roth conversions. You have to do those by the end of the year. The IRS allows us to make contributions to our IRAs, individual retirement accounts, and HSAs, health savings accounts, until the tax filing deadline, which is typically April 15th. This year, it's April 18th. So it falls on the 15th falls on a holiday. So the 18th would be the next Monday. I think that plays out, unless Monday's also, or a Saturday. April 15th falls on a Saturday or a holiday. So in this case, it falls on a Friday. So I didn't see why that is, but the filing deadline is the 18th. Of this year. So you have until April 18th to make these contributions. So now if you're going to try to push it as far as you can to the 18th, or the filing deadline, try not to do it right to then. Custodians can, and Sarah talks about this, custodians can accept it as long as it's postmarked, but please don't do that. You want to make sure that you've got some lead to be able to get these things done. Don't count on, your Vanguard, Fidelity, Schwab, anybody like that to get these done for you. Just count on yourself. We'll make sure, if you're doing a contribution, we'll make sure that it's done and in on time. But if you're handling it yourself, don't count on that person, that is on the other side of the mailroom to get that done for you. So Sarah writes, it may be hard to believe, but the countdown of the 2021 tax filing deadline is on, right? It's right around the corner. It's almost here. Really only a few weeks away. So is your IRA ready? She says. April 18th is the filing deadline for a 2021 IRA contribution. This is true even if you have an extension to file your tax return. Great point. Some people think, well, okay, I filed an extension. I actually don't have to file until October now. Does that mean I can still contribute? October? No, that does not give you extra time to make a traditional or Roth IRA contribution. So I am talking about both Roth IRA and traditional IRAs. And don't forget, there are also limits. So I'm going to refer to the limits. I'm going to pull down. I'm actually going to leave it there. So I'm going to share my screen with you again. And I'm going to show you where you can easily find these. Screen 3. So you should see on your screen now the tax charts. So here's where I got these. Raise your hand if you can see my website again for me. Thank you. So again, you're when you go to attleborowealth.com, you're going to go to this home screen, go over to the slot corner. Why do I put it there? People say, well, why are these charts under the slot corner? Because they're Ed's charts. I want to give him the credit for these charts. So this is the tax planning chart that I refer to all the time. I have it up almost every day on my computer, if not every day. You can download this, and you should download it. You can just use it on the chart here or on the website here, but if you download it, you have it, because next year there's going to be a new chart, right? 2023, and you might want to refer to that. Medicare income planning chart is on here. Now and also the 2022 retirement plan contribution limits. Now, wait a minute. We're making contributions for 2021, right? So are these the same? Well, we better make sure that we're following the right ones. It happens to be here that the 2021 and the 2022 are the same limits. So you're okay here, but pay attention to that, because if some people pick up charts different places, or, people send out emails of what the new updates are. And we're just, again, fortunate enough, I would say unfortunate, because why aren't they increasing these levels? They're so stinking small anyway. $7,000 is what you're able to contribute to your IRA or Roth IRA. But remember, there's rules around that. So you've got these phase out rules for contributions to the Roth IRA. If you're married, you can't make more than $214,000 of modified adjusted gross income. If you're single, that's $144,000, right? So, and you can't put a lot of money away. $7,000 is good. Times it by 2. If you're married, you may be able to do 14,000. You just got to check to make sure you're not over these limits. But you'll see that here is the phase out ranges for IRA deductibility. This gets a little more confusing, because you can make, if you make more than 129,000 as a couple, or $78,000 as an individual, you can still make an IRA contribution, but you can't deduct it. So, so use this chart. That'll help you. And I hope it'll help you simplify things a little bit in your life with IRAs. So lots of great information there. Take advantage of it. All right. So let me go back to my notes. All right. And here's where Sarah talks about the rules do allow IRA custodians to accept prior year 2021 contributions after the tax filing deadlines if they are mailed with a postmark of April 18th or later. Don't mess around with that, though. Be well ahead of it. You have time. And make sure that make sure you get it together, because then if they make it a 2022 contribution and then you make another contribution, well, now you've contributed too much and you're going to have to do a recharacterization. It's a real pain in the neck, or an adjustment out of your IRA. If you're making a 2021 traditional IRA contribution that is deductible, you will want to be sure to report it on your tax return to claim that deduction. If you're making a non-deductible contribution, she writes, be sure to file IRS Form 8606 with your tax return. The 8606 is kind of just a receipt for non-deductible contributions. And these are really, really important 10 years down the road, because in the future you is going to say, I made these non-deductible IRA contributions. So how do I add that up and figure out what is deductible, what's non-deductible? Well, I would say have 2 different IRA accounts if you're making a non-deductible and a deductible IRA, just so you can keep track of them. But certainly file the 8606 and keep copies of everything, of course, for yourself, because then you'll have the ability to stack that all up and remind yourself and have a paper trail and have documentation that you can refer to and show that you've already paid tax on the money that you contributed to that. Because it happens all the time where people say, I don't know, I put in about $20,000, and maybe they actually put in $50,000, or even if it's just $30,000. If you assume you put in $20,000, but you really contributed $30,000 after tax, well, what does that mean? When those funds are either converted to a Roth IRA or distributed, you're paying tax on those funds that you've already paid tax on. So double taxation is never good. Single taxation is bad enough. So keep track, work with a qualified, remember, rely on your team, work with a qualified CPA, work with a qualified CFP, certified financial planner, build your team, have your attorneys, have your people working for you. So that's how you claim what's called a basis in your IRA using that 8606. All right. Sarah goes on to other times. So if you're looking for to make a SEP IRA contribution, you may have more time. The deadline is different than those for a traditional or Roth IRA contribution. The deadline to establish and fund a SEP IRA for 2021 is the business's tax filing deadline, including extension. So that can go all the way to September. There is still time as well to remove an unwanted contribution. This is what I was talking about. If you made an over contribution accidentally or well, it would be accidental, right? Who would over contribute? There is still time as well to remove an unwanted contribution. For example, if you made a contribution to your traditional IRA and later discovered it was non-deductible, if that's not what you wanted, you can remove it plus earnings attributable by October 15th of 2022. So that is like the recharacterization. This is just a distribution and correction. But October 15th, 2022 is also the deadline to remove excess IRA contributions and avoid the 6% excise contribution penalty. If you miss this deadline, you will be stuck paying the penalty and it will continue to accrue each year. The excess remains in the IRA. So don't mess around with that. Make sure you're keeping good records and make sure you're doing it the right way. So the next is from Andy Ives. I don't think we've had Andy on yet, but he'd be a good one to join us one month. Roth contributions or rollovers. This is what this mailbag is. So the mailbag is when people write in and the Slott representatives answer their questions. I love these. Everything's good about what we get in here. Sometimes they're really complex, but these are good questions. So this is a financial advisor, a financial planner writes in, and he, he's read a couple of Ed's books. But hey, Ed, he writes, longtime reader and listener of yours, and have bought a couple of copies of your latest book to share with clients. Prior to us being involved, my client made a backdoor Roth contribution in 2021. So that's when you're over the contribution limits for Roth IRA contributions. So you make a non-deductible contribution to your IRA and then immediately convert it. Well, at some point, convert it. Should be immediate, but at some point convert it to a Roth. So you make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA. So the IRS currently says that is acceptable. It's just a way to backdoor that Roth contribution. In this case, though, he said he did this despite his income being below the threshold limits. So he could have just done a contribution to a Roth IRA. And sometimes people do these things. They read about these things, backdoor Roth IRA contributions, and they get, they want to get fancy instead of just looking at how they can do things simply. I see this. So this person could have just done a Roth contribution, but for some reason he wanted to get fancy with it, and he did this backdoor Roth contribution. Also, he had existing IRA balances. Is there anything he can do? So when you have existing IRA balances and you try to do this Roth backdoor Roth contribution, you can't just deposit $7,000 and then convert $7,000 into a Roth for it to, and it being tax-free. There's what's called a pro rata rule. So you have to look at the totality of your investments in any Roth or any IRA that's in your name, not just the one that you're contributing to. And then you have to only a percentage of what you convert is tax-free. Does it sound complicated? Yes, it is. That's why if you don't have to get fancy with these things, you shouldn't, because people get caught up in this all the time, and you cannot recharacterize Roth conversions any longer. So once you've done it, it's done. So he asked this. So this person had existing IRA balances. Is there anything you can do? Are the 2018 recharacterization rules such that he is stuck with any tax implications? That's from Graham. So Andy writes back, there's still time for potential fix. Can your client deduct 2021 contribution he made for the traditional IRA? If so, the deduction for that contribution, take the deduction for that contribution and do not claim the basis. Do not file that form 8606 that I talked about in the previous section. Then the backdoor Roth conversion he did will just be a regular taxable conversion. Makes sense. Assuming he has no other basis after tax dollars in his IRA, you will not have to worry about the pro rata rule. As for recharacterization, that is no longer available for conversions. As I said, it cannot be undone. Also, since the conversion is complete, he will not be able to recharacterize the original contribution. If he is not eligible to deduct the 2021 contribution, then he should file he should file Form 8606 and claim the basis. Now we have the pro rata rule to think about to determine how much of the conversion is taxable. By not paying attention to the Roth phase out limits, he has certainly created some complications. So don't try to get fancy. Keep it as simple as possible. We get fancy when we have to, and then you have to know the rules. And when people there's a lot of information out there. You can find anything you need on Google, right? There's a lot of things I've done watching YouTube videos, by following YouTube videos. Sometimes it works out great. Sometimes it doesn't. You don't want to mess around with it. I can't tell you the number of people who have half the facts and they come to me and they say, well, what about this question? What about that? What about this? I heard this and this person said that. My uncle, brother, cousin, plumber friend said this, or I saw this on YouTube. And it can get very costly in a couple of different ways, from an opportunity cost point of view and from a kind of having to unravel things point of view. Okay. All right, this is an interesting one. So this fellow did wanted to draw funds out of his 401k, invest in an IRA, and then convert it to a Roth. So good plan if that works for you, right? It depends on how large that 401k is. So let me just read this to you, and we'll talk about the details. But he says, hello there. I've come across your website while searching for support on a very specific problem I'm encountering. In January 2021, I left my previous employer, and since I didn't have a new 401k established at my job, I asked my existing 401k provider to initiate a rollover. Makes sense? Roll it over. My 401k consisted of both pre-tax and Roth funds, right? So funds that had not been taxed yet, and Roth. He had a Roth 401k option, but I only had a Roth IRA at the time. Long story short, despite asking the IRA custodian to facilitate a conversion of the pre-tax funds so they could go into my Roth IRA, the custodian deposited both amounts directly into the Roth IRA, rather than opening a traditional IRA, then doing the conversion. It is only now, while preparing my tax return, that I realized they have done this incorrectly. And again, long story short, he says, too late. They are refusing to accept ownership of the area or error or help to resolve it. Beyond saying the only mitigation I can take is to file an IRA recharacterization. The form looks fairly complicated since the funds have been in position since they were deposited at the start of the tax year. I'm also concerned by some of the statements in the Tax Cuts and Jobs Act, and I'm concerned some rollover dates may be violated as a result of performing a fix. I've reached out to a few CPAs online, but I'm struggling to find anyone who specializes in this issue just yet. I'm hoping you might be able to support me in rectifying this issue. So that's interesting because he found this, he wrote into this fellow, Jonathan, through IRAhelp.com, which is the Ed Slott Group's website. So if he would have went into that website, he could have searched for an advisor and put in his zip code, and one of us would have popped up. So there are 400 plus of us throughout the country. So he likely would have found somebody close to him who could have helped him with this, because the answer is a good one. And who answered this? Andy. Andy writes, well, Jonathan, that is a long story. Actually says a long story long. Good news that there is no problem with the transaction you outlined. Former pre-tax 401k dollars are allowed to be rolled over directly to a Roth IRA. This is a valid conversion. The funds do not have to be routed through a traditional IRA first. No need to reverse any transactions. No need to try to recharacterize anything. No need to push back on the custodian. No errors were made. Enjoy tax-free earnings in your Roth IRA, and congrats on a proper conversion with your 401k. So that's all well and good in this case, if this is what Jonathan wanted, right? So the 401k went directly to his Roth IRA, and it could be fine. This is probably a custodian like Vanguard or Fidelity, where they have the 401k and then they open up the Roth and they moved, or they were able to transfer the funds directly to his existing IRA, which is, listen, if you don't think that the folks answering the phones at those firms get some kind of financial reward for keeping the money in those accounts and creating new accounts, you're kidding yourself, because this is how it may not be a direct compensation, but it could be some kind of bonus. Every one of these financial firms have some kind of incentive for keeping funds in-house, opening new accounts and all this. So these folks are very, they have quotas to make, and they'll open up an account. They want to open up an account and keep the money there. So they'll do that for you like that. And it's not always done the right way. So there was no IRS violation here, but what's the potential for Jonathan? I don't know how big his 401k was. What if his 401k was $500,000 and Jonathan didn't want to convert that whole thing in 1 year? What if, or didn't need to convert the whole thing at all? So you've all learned that many of us can keep a certain amount in our traditional IRA and never pay tax on that money if it's the mathematically ideal amount for you. So in Jonathan's case, maybe he could have kept $250,000 in his IRA, but now it's all converted and he has to pay tax on it this year. Now, maybe it's a small amount. He doesn't share that with us. But if it was, for example, go back to the $500,000 and his plan was to roll it into an IRA and then convert it over time. Well, now he is really up a creek because he's got to pay tax on that entire thing. So that wasn't addressed in that question, but it certainly makes sense to look at everything, of course. All right, let's talk about the markets. So good week last week. The markets were up about 5.5%. The Dow Jones, the S&P 500 was up just over 6. The NASDAQ was up over 8. And really across the board, all the major stock indices, right? The things we watch, the indexes, however you want to say it, were positive last week, but still down for the year. So Dow Jones Industrial Average is still down about 4%. S&P 500 is down about 6%. The NASDAQ is down about 11%. And everybody, all the world indices, they're down, the highest being the NASDAQ, 11. The bonds are still down for the year. So bonds fell last week about 0.3%. And the aggregate bond index, Barclays aggregate bond index, which is the broadest index, like intermediate term bonds, right? Like let's just say 7 to 9, maybe 11 years maturities, it's down 5%. So everybody that flocks to bonds for safety, holy cow, you're also down 5% in that area there. So, challenging times for sure. We've got some really fun and exciting investment changes coming up over the next couple months that are going to help mitigate these things and offset these things. I've got some, I've got a great exchange traded fund that I found that I've been tracking for about 9 months now that writes option strategies that's giving a nice return and some stability. We're adding in some secured debt funds that have been working really, really well with some substantial yield and dividends. We're looking at introducing structured notes, something I did a lot of back in my times at Wells Fargo and a little bit over the years, but they have some really great issues. And we're in discussion with a bank, a large bank, to make some notes just for our clients. So they're going to be custom notes just for us, set up a certain way, trying to achieve what we want to achieve in our investment portfolios. So that's really some exciting stuff coming up. So when we're ready to launch with that, I'm excited to share all that with you. All right, so they are the markets as a whole. Let's look at the Fed funds rate. We didn't talk about, or the Fed funds target, right, is now 0.1%. A week ago, it was 0.25%. The 6-month Treasury is just, it's 0.78%. And the 10-year Treasury is now over 2%, 2.15. So, rates are coming up at some point. BlackRock talks about tough Fed talk on inflation, little bite. So they're saying they're talking big, but taking small bites. So that's probably the direction to take. I'd be moving slowly too, but I'd be very deliberate about it, and I'd be consistent about it. For some reason, flashing in my head here is, I'm a cyclist and just climbing up a steep hill. It's just, you're always thinking just kind of one crank on the pedals. And that's what it feels like here. That's what the Fed's going to have to do, no matter how painful it is. They're just going to have to crank each way to get us where we need to be. The problem is, where is that? And we'll have to address it as we go. I'm just glad I'm not a voting member of the Federal Reserve. So the Fed is talking tough on inflation, but projecting a large and rapid increase in rates. But we think it won't fully deliver and will be forced to live with inflation. BlackRock says. Why do I talk about BlackRock so much? I typically have some discussion about what they say here. They're one of the largest in the country, right? Or in the world. One of the most followed and well respected in the world. And what they say means something. So I don't always listen to what they say. One of their representatives who helps us look at our portfolios made some suggested changes about 6 or 8 months ago, maybe 9 months ago, and I didn't make those changes. I'm glad I didn't. So we don't follow everything they say, but it's good to kind of get the pulse of what these folks are thinking. The S&P 500 scored its biggest weekly gain since 2020, they said, and bond yields rose. Chinese shares rebounded sharply after officials reassured a panicky market. So that's good. They talk about some data in the week ahead, but nothing important. Robert DiLucia from Prudential had a really interesting article focused on the fear of a U.S. recession. And he had a lot. This is a concern I have, folks, is that we've got very high inflation. We've got this high demand. It's difficult to keep up with these things. I don't see that inflation. Some people are very optimistic about this drop of inflation. I don't share that optimistic view. I'm really concerned. Listen, do I think we're going to sustain 7.9%? I certainly hope not, because I don't know what everybody's going to do. It's really shocking, isn't it? When you fill up your gas tank and when you buy food at the grocery store right now, it is just shocking. Companies like Costco and, I guess Walmart and some others, they can really handle price controls. They can tell their folks that, I'm not going to pay that. You got to come up with something else or find somebody else. Right. So, but the smaller, and I mean, just slightly smaller than those big retailers, there's not a lot that they can do. And I don't know what's going to happen with the auto industry. The car that we bought for my wife, that we had to buy my wife a new car last July, is now, I think it's $12,000 or $15,000 more for the same car than it was last July. Now, that's ridiculous. And that is that's a 20% increase. It's crazy. Very, very difficult, challenging times right now. A lot of uncertainty. A recession concerns me. If you throw a recession now in the next 6 months on top of everything we're facing now, this war, which people are concerned can grow into a global issue, then what's that going to mean? But DiLucia lays out a lot of reasons why people are fearful about a pending recession and how it relates to some of the things that we saw in the 70s. So he writes, since the 1970s, many recessions have been preceded by a steep rise in wage and price inflation and a spike in crude oil. So we've seen that, right? We've got both of those things: steep rise in wage and price inflation and spike in crude oil. Virtually all recessions over the past 50 years have been preceded by an inverted yield curve. We're not seeing that. Every recession since the 1970s has been preceded by a prolonged Federal Reserve rate tightening cycle. I think we're going to see that, right? Slogging up that hill, the prolonged Federal Reserve rate tightening cycle. So he goes on, he lays out a lot of bullet points. And at the end, I highlighted it. He said, although I have trimmed my estimates for 2022 gross domestic product, the probability of recession is low in his opinion. And he goes on to write, in the absence of recession, the equity market, the stock markets, should post positive returns over the next year at a minimum. From current levels, a diversified domestic equity portfolio could generate a total return of 10% over this period. Pretty optimistic. But he's talking about from here, not for the year, but he's talking about where we are here. So if the markets are down 6%, and then we have some growth, and so it would take about an 8% return, maybe a little bit more, just to get even. He's saying we could see a little bit higher than that, and end up a couple of points for the year. It could be. Now talking it through, that could be. As I said in the beginning of the year, I think we're going to be up a couple percent or down a couple percent when we get to the end of the year. And by a couple, I mean 5% on either side. And by the way, I could be completely wrong on that. He continues to say stocks will remain at risk over the next several months because of enormous geopolitical uncertainty, of course. Until there is greater clarity regarding economic growth, monetary policy, and the Russia-Ukraine conflict, the equity market, stock market will be vulnerable to to further declines. This is going to be a very volatile year, folks. So strap on, make sure you're buckled in, don't put your hands outside the ride, and make sure you refer to your plan. You've got it in place, asset allocation, principal protection, account segmentation. All those things are going to help from an investment point of view, from a planning point of view. I hope you've got it worked out. Clients certainly do. If you're not a client yet, we will get there with you. Riverfront, one more, and then we're going to go on the financial planning. The current Riverfront writes, the current market situation is nerve-wracking. And then they write, asset allocation can help. It is. There are things that keep me up at night, and surely what's going on right now is one of them. They're right. It's hard to believe, but the end of the first quarter is nearly here, and a lot has changed in the mind of investors. In this weekly review, we reflect on what has transpired over the past few months, including why we feel there's a dramatic shift in sentiment, and key topics affecting the market. So I'm just going to share their key takeaways. Headlines are dominated by the tragic situation in Ukraine. We see it all the time. That affects everybody. A lot of people have strong feelings about this. A lot of people are directly affected. Market, especially in this area, we've got a heavy Russian-Ukraine, this area being Bucks County, Pennsylvania, Philadelphia. We got a heavy Russian-Ukraine population here. Market impact will be felt through inflation and thus the Fed, in our view. While we believe the stocks will be higher by year end, active asset allocation can be the best defense against volatility. That is Riverfront's opinion. Active asset allocation can be the best defense against volatility. They are an asset allocator. They are a money manager. That is their game. And yes, that's part of it. Asset allocation, principal protection, account segmentation. You want those three pillars there. Again, if you can add on there guaranteed income, well, that's the icing on the cake. All right. Let's see here. All right. Moving on to financial planning. No questions. Good. And here's our financial planning topic. I'm going to share my screen here. All right. You should see my whiteboard. Financial planning topic, non-qualified annuities. Annuities is spelled wrong. That says annuities. Who wrote that? There's no spell check in this, I've noticed, and I don't care for that. Okay. So let's go over some of the basics. What is a qualified and non-qualified annuity? So I'm just setting myself up here. You guys always hear me say this so I can look down. I had this funky thing happen where everything went blank when I was doing this, talking to somebody last week. So I'm being very careful here. All right. So what we're going to focus on this first here. What is a qualified and non-qualified annuity? Or what's the definition of qualified, non-qualified? Very loosely, qualified equals IRA and other retirement accounts. And it can be Roth, can be traditional, right? And I say very loosely because technically IRAs are not qualified funds. Qualified funds technically are retirement plans. Any CFP should know this, but we can't let it get in our way because everybody refers to these things as qualified to identify them as IRAs. So we'll just let that go. Non-qualified then would mean not in an IRA. So very simply, not IRA. And that also means not traditional IRA, not Roth IRA. So non-qualified is not an IRA, qualified is IRA or other retirement funds. I'm just putting this keyboard out of my way so I can refer to my notes. So now let's talk about pros and cons. So now we understand what this word means. Qualified is IRA, non-qualified is not an IRA. So let's talk about the pros and cons. The people will say that a pro of a non-qualified annuity, right? So let's do I'm just going to call it qual. So I don't have to write it all out. So we're going to do pros, cons, non-qual. They would say pros are tax deferral, right? You put $100,000 into one of these, it grows into $200,000. You don't pay tax along the way. Well, I would say that the con of a non-qualified annuity is what? Tax deferral. Yeah, because one of our goals is, remember, here are your buckets. So we have taxable, tax deferred, and tax free. So our goal is to fill this up as much as possible, right? We want this bucket. We want this bucket full. We want this bucket to have the mathematically ideal amount. And we want this bucket to have the mathematically ideal amount, but we want everything else into here. So if we start putting non-qualified annuities into here, they really straddle both of these. So to use my example of $100,000 in a non-qualified annuity, well, the $100,000 sits in the taxable bucket, and if it grows to 200,000, the other 100,000 sits in this bucket. So then they also have complex rules, right? So they have this rule called last in, first out, which is referred to as LIFO, which means this $100,000 is the last thing in the investment. This is the first thing, right? And if we were able to take this $100,000 out, which is when you take this out, that's your investment amount. That's what we call basis. So if you're able to just withdraw the $100,000, well, that would be a return of principal, so there'd be zero tax on that, right? But that would be first in, first out rule, and that doesn't exist in this because that's first, this is last, right? We're only talking about annuities here. Only talking about annuities. And this is only a non-qualified annuity, so it kind of straddles these two. So that means that the first dollar that comes out of here and all the dollars up to $100,000 or any growth have to come out of this tax-deferred bucket first. And what do we do? What happens when we take money out of the tax-deferred bucket? Well, we have to pay tax. And we have to pay what's called ordinary income tax. So you don't get the advantage of a capital gains reduced rate that you would get over here, potential reduced rate. You would pay ordinary income tax, which means, you've all seen this before, our graduated cylinder, 10, 12, these are current rates, 22, 24, 32, 30, that's a 2, 35, 37. Remember, this is like a graduated cylinder like we had in chemistry class. So this ordinary income fills up here, and that's where you land at wherever you're going to be, right? If all your income takes you to the top of this 22 bracket income, and now you want to take $10,000 out of your non-qualified annuity, well, now that $10,000 has to first come out of this last bucket, which means it's got to come out of here. You trigger this ordinary income tax. So now this $10,000 goes on top of your income, and you pay whatever tax rate you are. The problem, of course, is what's going to happen in the future. Well, taxes, we all believe, are going to be much, much higher in the future. And there's lots of reasons for that. So we're going to be taxed at the I don't know tax rate. And our studies show that the average middle-class American is going to be in the 40 to 45% effective tax rate. So why would we create a new tax-deferred entity here when our goal is to get as much money as possible over to here? Because now we got to figure out how to get that over to here. And I see it all the time. I was looking through the confidential data forms that we get from folks who are signing up for classes. And I started to see this fellow's annuities, and I said, oh, good. I like these. I like the companies. I like the structure. And then I saw that they're all tax non-qualified sitting over here, and I was, yikes. So now you just got to figure out how to unravel it, right? And I've never had a case where you can't figure out how to unravel it. It just is complex and a lot more work. So pros and cons. So the pros, people will say tax deferred. I say that's a con. And TIAA-CREF or TIAA were the ones who started annuities back whenever they started them in the early 70s, I think. They convinced Congress or lobbied Congress to put in the tax code this ability to have annuities. And it used to be, when I first got into business at Payne Weber, it used to be that it was kind of it wasn't really a violation, but it was seen as like inappropriate to put annuities in an IRA because you were duplicating the tax deferral. Well, who cares about the tax deferral? The reason you want annuities, in my opinion, and we're going to talk about best use. I don't want that to be red. That's no fun. Best use. I'll come back to that. We talked about tax deferral. The reason that you want these is principal protection and guaranteed income and, really those things, right? Principal protection. That's what I use it for, principal protection and guaranteed future income. So that's the best use for them. Forget about the fact that they're inherently tax deferred. We put them in this bucket or this bucket, right? The tax deferred or tax free. And if we start them in this bucket, then we want to move them to the tax deferred bucket via Roth conversions, so that along the way, your principal protection, principally to protected, is that a right word? Principally? No, principally, whatever. Your principal is protected, but but in the future, you're going to have guaranteed income that can come out of here, and you don't pay tax on this, right? Why create something that's going to lock up your future tax benefit? Doesn't make sense. So I would say a con here is tax deferral. Qualified, if we go to the qualified part of it, is, well, let's go back to other. So other pros would be, you can, again, principal protection, you can do lifetime income. And they're really the big things, right? Some kind of, and it isn't, not all annuities have principal protection. Some of them just have some of them don't have any protections at all. Some of them don't have, so that would be erased. Some of them have no principal protection, but they've got some guarantees for lifetime income. But I would say that if you're going to use them for these two things, again, better to have them in the tax deferred bucket and ultimately the tax free bucket. So that's the best use for the annuities, is in qualified or IRA for principal protection and future income protection. And in addition to that, there's also death benefit. There's a death benefit often with these, so that would be a pro. So I'm running out of room here. I'm going to reproduce pros and cons. So pros, cons. We're going to add. I'm going to say additional pros and cons. We're going to add death benefit. And this is for any of them, right? So non-qualified is going to have a death benefit as well. They pretty much must have a death benefit. Some of them have long-term care benefits. So that could be in either bucket as well. But again, if you're going to use them for these things that aren't tax related, why create a tax deferral issue for you? What else could there be? Trust. There can be trust, taxation benefits and trust. Now, this is a point. If I were to talk about non-qualified taxation issues in trust, this is where I might recommend an annuity that's not in an IRA. So I should reclassify what I said is most of the time, the large majority of the time, we're looking at IRAs and Roth IRAs for when we're using annuities. But I had a situation way back in the beginning, and a fellow's wife passed away. Fellow inherited his wife's assets, and in the will, you've heard me talk about this in the estate planning classes, I think. In the will, it said that that he must take the income that's developed by the trust. So it said, the will said, I'm going to put everything into a trust. This was very common, right? When I die, everything goes into a trust. His wife's will said, goes into a trust for the benefit of my husband and then my daughters, my kids. But it said the trust that's developed under the will must, it used the word shall, right? Shall pay any income that comes from the trust. Well, there's a couple of issues with that. First of all, this fellow didn't need it, didn't want it, and didn't need it, and he wanted to build up what it had, what went to his kids. So if the trust generated $50,000 a year in income, well then it would pay tax at trust tax rates. So we had to come up with an idea. It could have been municipal bonds, something that didn't generate taxable income, but then there was still a question about that. So we took and we put them in annuities for him. The annuities were able to defer, right? So we got opinions by his attorney and the attorneys within the two annuity companies we used. And here's the trust. And in this case, as long as those funds, let's just say $1 million, were in here and they stayed in the so these are non-qualified annuities. So not IRA, right? As long as they stayed in there, and because of the annuity structure, they weren't forced to put money out, because once there's income, if this was $1 million in a stock that produced a 5% dividend, let's just say, well, that dividend would have to be paid out, right? Because it said any income shall be paid out to my husband. So shall means must in legal terms. So that had to be paid out. Now, so that's $50,000 that would have to go out to the husband at trust tax rates, and trust tax rates are much higher than individual rates. Also, income he didn't want. He didn't want this. He wanted it to grow. He wanted to grow and be in there for his kids. So we were able to shelter that with using these two annuities, and it grew significantly over time. There was some basis in there. The kids paid tax on it when it was distributed to them, but it was because there was a death benefit that helped offset it. And then we also purchased life insurance to pay that tax. So it was a win-win for him, but that's the only instance I can think of where a non-qualified annuity would make sense. So to wrap it up, I hope you remember the difference. I know this is all over the place. I hope you remember the difference between qualified and non-qualified. So qualified goes into an IRA. Non-qualified is a non-IRA. A non-qualified has it's deferring tax on your earnings. You can remove the original amount that you put in, your basis, but you have to wait until you completely deplete these earnings, right? Remember that last in, first out. In most cases, there are some annuity companies, I can think of one in particular, that let you take a little bit out of each. But that's that's an unusual situation. But usually you have to take the $100,000 in this example first. You pay ordinary income tax. It adds onto your existing income, and you're going to pay tax on it. It will affect your IRMA calculations. It'll affect a lot of different things. How much you can contribute to a Roth IRA, how much you can convert in a year. There's a lot of things to consider there. And so for most times, it makes sense to do those in IRAs and Roth IRAs, mainly for, in my opinion, principal protection, future income, death benefit, with some long-term care benefits potentially. And every now and then it does make sense if you've got a trust situation where you don't want to pay income out of the trust, but you're stuck with that income out of the trust. Because really, if we would have had a chance to review the will prior, we would have just had the attorney rewrite that instead of shall, that they would have had it say may. That would have avoided the whole issue. So that was a little thing that we could have handled if we had an opportunity to. This woman passed away within a month of us first starting to work together. And we just hadn't gotten there yet. I hadn't even met her yet. I met the husband. We had just started transferring accounts in, and this happened. It happens, unfortunately. That's why you don't want to procrastinate, right? All right. And we talked about the investments. And analyst reports. We went over the Slott updates. And that's it for today. It's almost 11 o'clock. It's 10:58. We'll see you next week. That's it for this week. Please answer the survey that you're hopefully going to see when you log off. I hope that works out. I've asked Zoom to have that be the end page and not my booking page, because my booking page has no room in it until early or mid-April. If you're a client and you need us, we're available. We're here, right? We're here for you. Even if there's no time in the calendar, you need us right away. I was talking to a fellow last night, one of our clients, and he needs to go over some things, and we're scheduling time with him. But even so, if you're a client, you need us, and you don't see anything on the calendar, reach out and we'll get something scheduled for you. If you need something right away, be sure to reach out. And I'm looking forward to seeing you next week. And I'm really looking forward to seeing you live April 27th. See y'all. Have a great week.